We see that smaller companies have done quite a bit better than larger companies, right? You can see that small companies on the value side up about 25% in the last 3 months versus large growth companies actually down a little bit. This is as of the end of last week. Certainly two things. One is don't expect this kind of performance to repeat. It's very unlikely that small company stocks are going to go up 12% a quarter for the rest of the year, right? That would be pretty remarkable. But the other thing is this just points to the way that many people are invested is that a lot of times you see something like this. You see, and I'm going to go to the whiteboard here. And what we see is that if I draw this out into the different quadrants, and you see large companies up at the top here, and you see small companies across the bottom, and over here you see growth companies, and over here you see value companies. Right? Like I said, for a while, for several years, probably from 2017 onwards, you saw these larger growth companies really dominating. However, historically, the performance is quite different. If you invested $100,000 back in the end of the 1920s in these large U.S. companies, you'd have about $600,000. So pretty good. But if instead you invested $10,000 in these small value companies, you'd have $7.8 million. Right? So about 13 times more growth for small value companies than for large growth companies over time. The reason I'm bringing that up is, first of all, we saw a resurgence of some of these recently. But second of all, if you look at where most people that we meet are invested, it's mostly up here, large growth. This is where the S&P 500 falls. And you'll see somebody where something like maybe 35% of their money is here, and 20% is here, and 10 is here, and 8 is here, and then you get down here and it's like 2% and 1%. So just where markets historically have done the best is where people have the least exposure. So you want to take a look at where your funds actually lie and make sure that you've got exposure across the board. Turning back to the slides, I want to continue on here. We'll restart the slideshow and take a look at international, right? And so as we talk about international, similar story. Where international stocks, the value has done better than the growth, and the small has done better than the large. So these phenomenon, they call them factors or premiums, where historically small companies have done better than large, value companies have done better than growth. Turns out higher profitability companies have done better than less profitable companies. They've been persistent, not only in the United States over time, but also internationally. Again, you want to take a look at how you're invested, make sure you've got exposure across the board. Also, keep in mind, for those of you approaching retirement, at some point you want to distribute income. You want to pull money out of your portfolio. What's the number one rule in investing, above and beyond everything else? Buy low, sell high. Well, when you're distributing income to yourself in retirement, you want to sell high, but you need to sell because you need money in your pocket. Having some diversification among the U.S., international, small, large, et cetera, allows you to pick what's doing the best, sell that in any given month or year to put money in your pocket to live on, and you can get back to selling high and hopefully buying low. Right? Want to flash forward a little bit and just point out here the S&P 500 and the fact that it is dominated by growth companies. And so if you look at the technology here in this center column, you can see that roughly 45% of the growth index is technology in here. You can see on the other side that financials have very little weighting in the growth index. You can see that materials and energy have very little weighting in the growth index. The reason I'm bringing that up is because you want to consider what index you're investing in, because those sectors are going to have a big difference, right? If you look last year, you can see that online retail did the best. It makes sense. You're trapped in your home. You can't go out. You're going to order online. Information technology, IT, did the second best, right? Those are heavily dominated in the S&P 500 and in the growth index, which means that growth indexes and large companies did a little bit better the first part of the year. If you flash forward, what do you see this year? This is just in the last 3 months. You can see that energy is up 30+%. Financials are the next best performers, up 16%. Industrials up 9%. Those are all value sectors for the most part. And so that's part of the reason is the sectors that did the worst last year are doing the best this year, which is contributing to outperformance. Reminder of a powerful phenomenon in financial markets, which is reversion to the mean. What did the best lately doesn't always do the best going forward. Reversion to the mean is really powerful. Keep in mind, though, right, the next question would be, hey, are some of these value stocks or small companies now overvalued? I don't have a crystal ball based on what's going to happen next week or next year. But I will say that based on historical precedent, despite the recent recovery, many small and less expensive stocks are actually still quite cheap compared to historical norms and compared to growth and large companies. Right? I mentioned earlier that some kinds of companies haven't done as well. Some, small companies or value in the last 5 or 10 years as opposed to large growth. The US had done better than international stocks. Same thing with emerging markets. Here's an emerging market chart for the last 5 years, or for the last almost 20 years. And what you can see is that we're basically back at the same level we were back in 2007, 2008. So despite a lot of economic growth in emerging markets, you've essentially seen no stock market increases in the last 12 plus years, right? And so when you hear, hey, valuations are stretched in stocks, are they too expensive? It's really important to dive under the hood, see what kind of stocks you're talking about. I want to shift focus and talk a little bit more about inflation. But before I do, I just want to see if Rob has any questions.
At the moment, the only question we have would be, how is the Vanguard Total Stock Market Index invested between large growth and smaller value stocks?
Yeah, really good question. So most of those broad market indexes focus on something like, let's call it the Russell 3000 or something like that, right? And so the idea is that you're getting broad diversification. You're getting all 3,000. There's about 3,500 stocks in the US. So the Russell 3000 is 3,000 of them. So you would think you're getting a lot of diversification. It turns out you're not getting as much as you might think. So if you look at the Russell 3000, which is the broadest popular index in the US, about 90% of that is in the S&P 500. The other 10% is in the next 2,500 securities. So even though it owns the whole universe, it's very heavily weighted towards the largest companies. In fact, more than half of that index is in the 100 biggest companies. The remaining less than half is in the other 2,900. So you're not getting quite as much diversification as you might think. It's also skewed towards growth companies at the expense of value. Those broad funds can be good, but a lot of times it makes more sense to reconstitute them, figure out what for you your appropriate for your situation mix of large, small value growth is, and then go out and buy more specific funds to kind of rebuild the way that's best for you. Right? Like I mentioned, that inflation, right? I want to start by acknowledging that over time things get more expensive. And so this looks at the cost of living since World War II. You can see that it's generally gone higher and it's gone up about 13-fold during that time span. So gradual increase, but over time it becomes quite meaningful. That's why when you go to McDonald's, depending on your age, you might remember a Happy Meal being $1. Now it's $8 or whatever it is, right? Things get more expensive. I also want to acknowledge that a lot of people don't necessarily believe the government statistics around inflation. They'll say that the Consumer Price Index, CPI, isn't meaningful because it isn't accurate. I'm not here to argue one way or another. There are a lot of different inflation measures. Most of them track relatively close, but are they completely accurate? No. And more importantly, they're not specific to your circumstances, right? They're a broad basket of goods. You may spend your money differently. Maybe the things you spend money on are going up more expensively, right, or more quickly than what the Consumer Price Index is, right? The other thing is there are substitution effects in there, so that let's say you love an iPhone and the price of an iPhone goes up. They might take the iPhone out of the basket and put in a new phone that's at the same price. If you still want an iPhone, your cost of living has gone up, but the basket being measured for inflation hasn't gone up. Right? That being said, people worry about higher inflation, right? Here it is since 1996. Inflation in my career, I started in 1996. It's a little bit like the boogeyman, right? Often feared, rarely seen. Since 1996, inflation's only been above 4% on a couple of instances. It hasn't been above 4% since, 2008, something like that? It has averaged about 2% during that time. Spread that time horizon out since the 100-year average, 3.7% for inflation, right? 3.7%. So inflation, something people worry about. Why? Because they remember the 1970s and early 1980s, double-digit inflation. Double-digit inflation can destroy an economy. Those of you living back then might remember it. There are other examples. Back in Weimar, Germany in the 1920s, people, you can Google this, there's pictures everywhere. People would get bales of money and they would burn it, the Deutschmarks, for fuel because the money wasn't worth what you'd use to buy wood. Money was worthless. Argentina at one point had so much inflation, people would get paid twice a day. You get paid at lunch, run out to spend it because the money would be worth so much less by the end of the day. Hard to run an economy under those circumstances. But even at more modest levels, at 2% inflation, your cost of living doubles every 35 years. At 3%, it doubles roughly every 25 years, 20 years, something like that, right? So inflation will eat away at your purchasing power. That's why you need to account for it when you look at your financial planning, right? One thing you can do if you're worried about inflation is run your financial plan at a little bit higher inflation than what we have today to see if you can still withstand that and maintain your standard of living, right? We get asked all the time on inflation, why does the government look at CPI or any kind of index less food and energy? The old joke is, well, that's great if you don't drive or eat, but most of us do, right? Maybe we didn't drive so much during COVID, but now we're back in our cars, at least judging by the traffic here on the Southern California freeways, right? So the reason they do it is this, is that food prices and energy prices are very volatile, right? You get a freeze in Florida, orange juice prices go up. You get an accident in the Middle East or something like that, a pipeline bursts, energy prices go up and vice versa, right? It's hard to make monetary policy that's looking forward 6 months to a year based on those fluctuations. So what they do is they strip that out and make monetary policy based more on everything else, less that volatile food and energy. And you can see like in a year like 2021 or 2020, over 12 months, food prices were up, energy prices were down. The truth was somewhere in the middle, which is why the government looks at it that way. One of the impacts, though, of rising inflation, right? And so here's our view or my view on inflation is I think inflation could certainly go higher over time. I do not think we're going back to the 1980s. I think the government, the Federal Reserve knows how to fight that. But I do think we could see slightly higher inflation. And so it's like, what kind of impacts could that have on your portfolio? Well, here's the dollar in the last 50 years. One thing that happens when inflation goes up, I mean, at its definition, higher inflation means that dollars are less valuable, right? As the dollar weakens, that is a positive if you own international stocks. So one way to protect against higher inflation is to own some global diversification, right? Those international stocks as a U.S. investor are worth more if the dollar declines, all else being equal. Another thing to look at is Treasuries, right? Government bonds. People worry about inflation and the impact on bonds. And think about it this way. If I lend somebody money for 30 years and it's the US government and assuming I'm going to get paid back, the real risk is that the dollars I get back aren't worth what they were when I lent the money, right? Inflation has eaten away at my purchasing power. Higher inflation is really bad for bondholders. So how do you protect against that? Well, one thing you can do is you don't own very long-term bonds. Think about it this way. If I lend somebody money for 30 years at 3% and now I could get 5%, I'm stuck with a below market rate for 3 decades. That's really not a great situation. If I lent somebody money for 2 years at 3% and now the rate is 5%, I'm still not really happy, but I only have to wait a couple years before my money comes back to me and I can reinvest it. A lot of people think interest rates are going higher. Again, back in the 1980s, they topped out in the mid double digits. They've more or less been coming down since then. My background, I was a bond trader on Wall Street in the mid 90s. And then I transitioned to where I was an institutional portfolio manager, managing bonds for big institutions, right? So I've worked in the bond market for many, many years, several decades. Every single day in the 25 years I've spent in the financial markets, for the most part, people have thought interest rates are going up, right? I'm generalizing, but people always think interest rates are going up. When they were at 5%, they thought they were going to 7. When they were at 7, they thought they were going to 10. When they were at 2, they thought they were going to 3. Yet despite that, most of the time, interest rates have gone down. Now, in the last, 10 years or so, we've basically seen interest rates fluctuating between 1.5% and 3.25%, with the exception of COVID. We dipped all the way to 0.5% on the 10-year Treasury. We've since gone up, and now we're at about 1.7. So we're back in that range. I don't know if interest rates are going higher or lower going forward. My guess is they'll probably go a little bit higher, but that's just a guess. But it's more about remembering that no matter what interest rates do, as a bondholder, you're getting diversification because they don't move in lockstep with stocks. They're also safer than stocks. Think about it this way. Last quarter, so the quarter that's ending today, the main bond market index, the Barclays aggregate, was down about 3%, which isn't great. That's one of the worst performances in history, right? Going back to 1980. Last first quarter, stocks fell, 35% last March? So 35% in stocks, 3% in bonds. Obviously, the upside with bonds isn't as good, but they're not there for big gains. They're there for stability. They're also there to generate some income. As a bondholder, when interest rates go up, you get a raise. If you want income from your bonds, the best thing that can happen is that interest rates go higher. Everybody for the last 10 years, rates have been low. They're worried rates are going higher, forgetting that higher interest rates are the best thing in the world that could happen to you. It gives you a pay raise, particularly if your bonds are reasonably short term. If the average maturity of your bonds is shorter than your time horizon, you want interest rates to go higher, because when they do, you can reinvest the proceeds at those higher interest rates and get more income. Let me take a brief pause. Rob, are there any questions on inflation or interest rates?
Yes, sir. First question here would be, do you think the FANG stocks have run their course?
So by FANG, just for those not familiar, that's what Facebook, Apple, Amazon, Netflix, Google. Some people lump Tesla in there. I don't know what the abbreviation then would be. But yeah, those are the big handful or half dozen tech stocks that really led the market from 2017 to probably last summer. That's tough to say. And I want to be clear, I don't have a crystal ball, but here's my view on it, is that it's not unusual for a small subset of stocks to dominate the market for a year or two, or even a period of time, 5 years, right? It is unusual for those same stocks to dominate the market indefinitely, for the simple reason that the bar for success keeps getting higher. I mean, if you run the math and Amazon continues to grow at a certain rate, all of a sudden they've taken over the world, right? Every single person would spend every waking hour on Amazon. And, in my home, judging by the number of boxes that arrive every day, we've almost reached that tipping point. But the reality is that no company grows forever. And it's not about whether or not you're doing well, it's whether or not you're doing better than expectations. When you get to be $1 trillion company, expectations are pretty high. So my view is that you probably won't continue to see for a long period of time. Now, any quarter, any day could be different. But over the next 5-10 years, I don't think you'll see those FANG stocks outperform everything else by a similar measure that they outperformed recently. That's not to suggest they're going to go under or go bankrupt or anything like that. This isn't the 1990s with most of them. They're not, fly-by-night companies. They're big, huge companies, good business models, lots of profits. I just don't think they'll outperform everything else the way that they did the last handful of years.
And as well, how do you protect and prepare your portfolio for coming inflation?
Yeah, so and again, who knows what inflation is going to do? My personal view is it'll go a little higher. I think there's several things you do. First is the way you build a portfolio is you run your cash flows to see what kind of required rate of return you need. How much income are you going to have coming in for the next several decades? How much money are you going to have going out? How does your portfolio need to grow to meet your needs? Then you build your portfolio. So one of the things you want to do with those future expenses is assume a rate of inflation. So one step is run inflation at a little bit higher rate. Here at Pure, we usually do 3.7%, which is the 100-year average, as opposed to the more recent, call it 1.5% or 2%, right? A little bit of measure of inflation protection in there. The second thing is you look at what kinds of investments you own. And I'll broadly generalize, but maybe there's a few different categories. Maybe so let's say, maybe you've got U.S. stocks, so I'll call it U.S. You've got international stocks. Maybe you've got natural resources, and maybe you've got bonds, right? I'm probably missing a few, but this is just to give you an example. You go through your portfolio and you look at the different kinds of securities that you own. And by the way, I'll apologize in advance. I literally flunked second grade handwriting in Catholic school, and that was with a pen and paper using my finger on a whiteboard. It's pretty ugly, but you get the concept. Right? How are these parts of your portfolio going to do if inflation increases? Well, historically, good companies have had a measure of pricing power, where if the cost of their inputs goes up, they can raise prices, right? A lot of us, I think that if, let's say we have an iPhone, if our bill went up a couple dollars a month, we're probably not going to get rid of the iPhone. We're too married to that ecosystem, right? So U.S. companies have some measure of pricing power. So you have some protection against rising interest rates there. Not to mention the fact that there are certain industries, like the financials being one, that often do well when interest rates go up. Right? Maybe you have international stocks. Well, I already mentioned that if inflation goes up, the dollar, all else being equal, tends to weaken over time. That's a positive for international stock holding. So maybe you've got some protection there. Natural resources. Let's say you've got some commodities or something. Well, historically, natural resources have done pretty well in periods of rising prices. So you've got some protection there. So it's really going through your portfolio, looking at the different types of investments and seeing if each component is going to do okay in inflation. And there may be some that won't. Bonds aren't going to do that good with inflation, right? So maybe you've got a couple parts of your portfolio in here that are going to do okay if there's inflation, and a part here that isn't going to do as well. But the flip side is, what if COVID resurges, right? What if it comes back more deadly? What if whatever else happens and we get back to deflation? Well, in that case, some of these asset classes aren't going to do well, but bonds will. And so as you build a portfolio, you're looking at taking different kinds of securities that are going to do well in different circumstances and putting them together. That's the concept of diversification. What happens when you do that is, if any one outcome or one company does better, you're lowering your ceiling, right? You don't have the ability to say, hey, inflation's going higher, I'm only going to buy what's best when there's inflation. You're lowering your ceiling, but you're also raising your floor. You're building a portfolio that's going to do okay over a wider variety of outcomes. For most people, as they approach retirement, that makes sense, because a lot of people, it's not about, hey, I need 15% a year. They don't need to hit a home run every time up. They just need to make sure they don't strike out. They need to get that fat middle of returns, those mid-single digit returns that will allow them to get to and through retirement, replicating their lifestyle. What other questions?
One more at the moment. At what point would TIPS be most attractive?
Yeah, that's a good question. So TIPS stands for Treasury Inflation Protected Securities. So what a TIP is it's a U.S. government bond that the value of it increases if inflation goes higher, as measured by the Consumer Price Index, CPI. So when TIPS do well is if inflation's going up a lot. Here's the challenge. And so TIPS can make sense. We own them in some of our portfolios as a percentage. The reason you don't go all into TIPS is simply this. If inflation is going higher, TIPS do well. If people are worried about inflation, but it's not actually increasing, TIPS don't do well. And what I mean by that is, if we're worried about inflation going higher, but we haven't actually seen it in the Consumer Price Index, interest rates are going up because we're worried about higher inflation, the value of those TIPS is falling, but the price isn't resetting because CPI hasn't actually moved. So rising inflation as measured by CPI, TIPS can make sense. Falling inflation or rising interest rates with stagnant inflation are not a good combination for TIPS. All right, what I want to do now is I want to turn a little bit towards taxes. And, you can all basically answer the question for yourself for what you think taxes are going to do in the future. But, I think that most people that we meet say taxes are going higher, and here's why. This is the U.S. debt clock. And this is a cool website, except that it's really depressing because every time I pull it up, the numbers are bigger. And I'm not going to try to draw with this with this mouse. But over here where my mouse is going over, you can see the U.S. national debt just shy of 28 trillion. That's a really big number. That's what the U.S. government owes. Oh, and by the way, that's before the recent $3 trillion stimulus package or $2 trillion stimulus package. It's before the infrastructure package that was proposed today. It's before additional government spending that's being planned, right? That equals out to about $85,000 in hock for each and every citizen. So however many of you there are on here, look in the mirror. You owe the U.S. government or the U.S. government's creditors $85,000. So adjust your personal balance sheet down, right? That's a lot of debt, and it's increasing. Now, it's controllable right now because interest rates are low, so the actual payments on that debt aren't that great. If interest rates were to go higher, it could become more problematic. But here's the challenge, right? When there's a large debt, there's only a couple ways to satisfy it. There's 4 ways. You can default on the debt, okay? I do not believe the U.S. government is going to default on its debt. There could be technical instances in which they don't get paid on time and government standoffs. But as far as truly not paying back its bills, I don't think that's going to happen. And if it does, we've all got bigger problems. At that point, the best asset classes are going to be canned goods and cabins in the mountains and stuff like that. The second scenario is that you can grow your way out. So if the economy gets a growth spurt, tax revenue goes up even with the same tax rates, you get out of debt. That would be great. Some of that happened to a degree in the 1990s. It'd be nice. I don't know if I'm counting on that. The last 2 ways are you can inflate your way out, right? You pay back that debt with less valuable dollars. That's one of the reasons I think inflation, again, I don't think inflation is going to spike, but I could see it drifting higher. The fourth way, and I think the most likely way, is that you tax your way out, right? And this is what I think is most likely to happen, is that taxes will go higher, right? And here is the important part, because we talk about investing, but it's not what you make, it's what you keep. And if taxes are going higher, that becomes even more important. And so when we talk about retirement and drawing income, there are three main pools of money you can pull from. There's a tax-free pool, there's a taxable pool, and there's a tax-deferred pool. And I think it's a little bit off camera here, the which pool? The tax-deferred pool, if we can fix that camera just a little bit. So three different pools of money that work three different ways, right? The tax-free pool, you get no break when you put money in, and there are rules and restrictions around putting money in, but your money grows tax-free and it comes out as zero as the name implies. The taxable pool is sometimes called non-qualified. It's a non-retirement account. There are no rules or restrictions. It's completely flexible. You put money in, you can do whatever you want. You can take it out whenever you want. The dollars you put in form a basis. So you've already paid taxes on those dollars. You don't owe taxes again. However, any gains you will pay taxes on. Depending on how that's invested, you can either get taxed as ordinary income or at special long-term capital gains rates of anywhere from 0 to 20%. For a lot of folks, that's 15%. If you make more than $200,000 as an individual, $250,000 as a married couple, there's also a 3.8% surcharge to pay for the Affordable Care Act. Then there's the tax-deferred pool. These are your IRAs, your 401ks, and the like. You put money in, you get a tax break. The money grows tax-deferred. When it comes out, it's taxed as ordinary income, anywhere from 10 to 37%. So three different pools, three different methods of taxation, three different tax rates, different benefits and challenges to each. One of the issues that we see, though, is that a lot of people have a lot of their money in an IRA or a 401k. So a typical person, if they had, I don't use a round number, $1 million, they might have 950 here, they might have 45 here, right? And they have 5,000 here. And the only reason they have 5,000 here is because they saw me talk and then they moved the money into this, right? So the problem is that you have no flexibility around this, because at some point you're going to need the money to live on and you're going to take the money out. And even if you don't need the money, starting at age 72, there's something called required minimum distributions, where the government forces out about 4% the first year, and every year after that it increases. If you don't take the money out, your children or your heirs are going to be forced to take it out, something known as income in respect of the decedent, IRD. It'll be forced out to them over a 10-year period. So the money is coming out. The government gave you a tax break. The person with $950,000 in this pool doesn't have $950,000 because their investment partner is the Internal Revenue Service. They have $950 less the IRS's share. Guess what? The IRS can change that share at any point, and there's nothing you can do. Do you think it's going to shrink? Do you think you're going to get tax cuts, or do you think you're going to get tax increases? Right? If you look at where taxes are, right now today, there's a 10%, a 12, a 22, 24, 32, 35, and 37. These have been around since the end of 2017 with the Tax Cut and Jobs Act. They're the lowest rates we've had in record, right? Prior to this, we also had pretty low rates. We had the 10% was the same, the 12 was 15, the 22 was 25, 24 was 28, 32 was 33, 35 was the same, and 37 was 39.6. So these were some of the lowest rates in history, and then we went and we lowered taxes. For those of you that predicted or guessed when I asked the question that taxes were going to go higher, you're right, because in 2025, at the end of the year, these low rates are scheduled to revert back to the old ones. This was not a permanent tax cut. It was a temporary tax cut. So absent any government action, tax rates going higher after 2025. However, there's talk right now about raising some of these rates even sooner. So the bottom line is that at some point, taxes are likely to go higher. Oh, and by the way, not only are the old rates higher, the brackets are also narrower. So for instance, as a married couple, the top of the 24% bracket is about $325,000. The top of the 25% was like $150,000. So you have more dollars being taxed at higher rates in the future, right? So this is why we talk a lot about keeping what you have and minimizing your future taxes. Because what you want to do is you want to put yourself in a position where you can pull money from whatever account makes the most sense. Right? Maybe you have Social Security coming in. Well, Social Security is taxed as ordinary income. Maybe that takes you to here, right? But now you want to live here. How are you going to get that money? Well, how you get that money, how you take it out, is going to determine how you're taxed. Right? If you take the money from a tax deferred account, it's going to be taxed as ordinary income and push you into higher brackets. So what we see is a lot of people will focus on getting some diversification into all of these pools. So what you might consider, if you haven't already done so, is evaluate some contributions to your tax-free, to the Roth, whether those are Roth IRAs, there are income limits there and contribution limits. Maybe you have a Roth 401k you could evaluate. Maybe there's a Roth conversion that makes sense. So conversions are taking some dollars from your IRA or 401k, moving it to the tax-free pool. When you do that, you do pay taxes, but you're always going to pay taxes on this money. Your only choice is when and at what rate, right? Maybe you want to build out this pool, right? I mentioned those other tax rates. Well, the long-term capital gains rates, those special preferential rates you get in the taxable pool, if you're in this top bracket, it's 20%. If you're in the middle here, it's 15%. And down here at the bottom, it's 0. So as you can see, it's always lower, the long-term capital gains rate, than your ordinary income tax rate. So if you do it right, you can get preferential treatment from this pool as well. And so getting diversification in these three pools is really the key to a tax-efficient retirement. The other thing you then want to do, and this is bringing it back to investing, because like I said, I used to manage money for institutions. This stuff didn't matter because they didn't pay taxes. You guys, your taxes matter, right? It's not what you make, it's what you keep. So you build a portfolio, right? Whoops. Maybe you have a mix of assets, right? Maybe you have, I'll just make this up. Maybe you have some US stocks, some international stocks, some bonds, and some small companies, right? So not saying that's the right mix, that's just an example. What a lot of people do is if they have money in each of these pools, they go out and they put this mix in each of those. But that's not what you want to do. Keep in mind, so this is as close to free money as you're ever going to get. The benefit of this tax-free pool is that it grows tax-free and it comes out tax-free. You're never going to pay taxes on any gains. So you put the investments that have the most expected gains in there because you're never going to pay taxes, right? The downside of the tax-deferred pool is that you're going to pay taxes on the gains at the highest possible rate. So you put the assets that have the least expected growth in there, right? It's not that you don't want your portfolio to grow. It's just that you've got slices with different expected growth rates. You put the more conservative ones in here. By doing this, you're not changing your mix. This overall mix will look like what you want. Each portfolio may be different. You're being more efficient, keeping more money out of the hands of the IRS. That's how you get free money. Free money there sounds sleazy and cheesy and stuff like that. It's not free money, right? What it is tax-free growth, as much tax-free growth as you can by choosing which asset class to hold in which pool. I'm going to clear that. So again, there's different ways to move money around here, but the key to a successful retirement is to have a little bit in each, right? I'm going to have Rob give us some more questions as he's popping up here. Just one thing is, I've been talking about a lot of stuff here today. Do something with the information, right? The most important thing is not necessarily knowledge, it's action on that knowledge. Otherwise, this is just a waste of 45 minutes of your life. Take this information, go back, look at your portfolio, see what kind of mix of small and large, value growth, US, international you have, see whether that's the right mix for you to meet your goals. See how your assets are laid out, how much is in tax deferred, how much is in taxable, tax-free. Is it appropriate for you? What tax bracket are you in today? What tax bracket are you going to be in the future? Run those calculations, figure it out. Look at where you're going to be, right? Do something with this information. Talk to your financial professional. If you want, my firm usually charges $200 an hour to meet with people. For people that have gone to this webinar and to help people through COVID and stuff, we offer free financial assessments. If you're interested, you could click on the form. There's basically a free financial assessment. You come in, we'll spend a couple hours with you. We'll go through this. We'll look at how your assets currently are allocated, whether or not your investment mix is appropriate, whether or not your tax mix is appropriate, where you're going to be with taxes now and in the future. You can spend some time, like I said, there's no charge, no obligation. You can spend a couple hours with one of our certified financial planners to see if there's anything you should be doing today to either evolve your portfolio for the future for potential inflation, potential higher taxes, to see if there's anything you should do to reposition your taxes for a potentially higher tax environment. Again, no cost, no obligation. That offer will be up there. Click on it if you're interested in doing that. With that, let me slide into any questions, Rob.
You bet. What criteria do you use for converting tax deferred to tax-free accounts?
Yeah, that's a great question. It's not as simple. So I wish that there was a number where it was like, hey, convert X, right? It's not that simple. What you do is you look at where you are from a tax bracket today. Okay. Then you look at your cash flows and determine where you're going to be in your taxes in the future and what impact required minimum distributions or distributions from your IRA are going to have on your future taxes. And you convert enough to keep it from pushing you into higher brackets in the future. It's not simple, but that's how you do it. You look and you say, all right, making this up, but you've got $500,000 here. That's going to push you from, let's say, in the future, the 25 to the 28% bracket. And now today you're in the 22% bracket. Well, maybe it makes sense to convert some of those dollars at a lower rate today to save it from pushing you into a higher bracket tomorrow.
Should I take a chunk of my tax-deferred SEP IRA and do a Roth IRA conversion now while taxes are at their lowest?
I have no idea. I don't, I like, so I'm being a little bit facetious. I like the thought process and the fact that the questioner is asking that around, hey, if taxes go higher, are there things I should do today in order to position? I think that's absolutely the right train of thought. I can't answer that question simply because I have no idea what the person's finances look like. If maybe they're making $700,000 a year now and they're retiring next year, it might not make sense. So it really depends on your current and future income and stuff, as well as your other assets. But I think you're on the right train of thought as far as at least evaluating whether or not that makes sense.
Got it. Can you discuss the strategies of reconstituting a COVID-related distribution from a 401k back to an IRA?
Yeah. So basically, what that's referring to is that there's something known as a coronavirus-related distribution, CRD. And so that was from last year as part of the government's response. Usually, again, there are penalties associated with taking money from a tax-deferred pool before age 59 and a half, right? But a lot of people had all their money here. They were hurting. They were out of work. Their restaurant shut down. So the government let people take money out without penalty if you're under 59 and a half, and B, usually any money that comes out of this tax-deferred account is due. You have to pay taxes on it. It counts as income in the year you do it. For last year, you could stretch that income out over 3 years. So let's say hypothetically, you took last year $90,000 from your 401k. Now, it needs to be for some sort of coronavirus-related economic hardship. It was a pretty broad window they described, and you have to self-attest that that's what it's for. Rather than having $90,000 worth of income on your 2020 tax return, you'd have $30,000 in 2020, $30,000 in 21, $30,000 in 22. Right? You also have the option of putting that money back in anytime within the 3 years, and it's as if it never happened. So in order to determine whether or not you should do it, again, it's as simple as, do you really need the money? Did you take it out as a precaution in case things got worse and they didn't? Maybe you want to put it back. Are you in higher tax brackets today than you would be in the future? Maybe you want to put it back. Or frankly, if you're going to recognize this income, when you take this out, this coronavirus-related distribution, the money comes over here to the taxable pool, right? This is probably the second best place to have money, right? But this is the best place because it's tax-free. If you're going to realize $90,000 in income, maybe you're better off doing a Roth conversion as opposed to putting it over here. So you want to evaluate those things.
In general, if you have all three of the free, tax-deferred, and taxable accounts, what type of assets go into the tax-free versus tax-deferred, specifically small cap versus large cap, value versus growth?
Yeah, so it's a good question, and that gets back to, again, that asset location. It depends on exactly what you own and how you're invested in it. But in general, what you want to do is stack rank the different investments. So let's say you had 10 different investments. You would just rank them 1, 2, 3 by highest expected return down to lowest. And you'd put the highest in the tax-free, you'd put the lowest in the tax-deferred, and you'd go from there. In general, you probably want smaller companies have higher expected returns. So you might want small cap stocks in the tax-free. Emerging market stocks have had high returns over time. You might want them up there. Stocks generally up there. Again, bonds, you'd want to fill up in the tax-deferred and then put whatever else is in there. In this taxable pool, you want to have some investments that are going to, mostly stocks, because you want to take advantage of these special long-term capital gains rates. You also want to be able to tax loss harvest on a regular basis. So again, it depends on exactly how many dollars you have in each. But for the most part, smaller companies, emerging markets are the kinds of things you want to focus on up here, bonds over here, and then maybe large cap stocks over here. I'm generalizing, but.
Thank you. And one more. What do you think is a safe assumption for growth of a 100% equity portfolio, accounting also for inflation and with a 10% small cap value tilt?
I mean, that's really hard to say. I'm not looking under the hood of that. I would say that the long run average of stocks, depending on the index, is somewhere between high single digits and low, call it 10 or 11%. Stocks have had a pretty good run. I think that if you want to be conservative, you might assume, I don't know, somewhere in the 7 to 10% range for stocks. Bonds, whatever bonds you have are going to return something lower. So, but I think I would probably go with something in the high single digits, and then inflation would come underneath that. So if you assumed, let's say 9% and inflation's 3%, your after inflation return would be 6%. And I just know somebody out there right now.
That's all we have at the moment.
Brian guaranteed me 9% returns, right? Not the case. But I think that's probably that 8-9% range is probably a reasonable guesstimate going forward. And then if you're looking more at some of the emerging markets and maybe small company value, maybe you're looking at 10% or something like that. Cool. Well, yeah. Well, this has been great. Again, do something with this information. Click on, if you want to come in, talk to us. Like I said, there's no cost, no obligation, but do something with this information, especially around the taxes. This is something so many people have ignored. We're looking at an environment where just today, the government's floating proposals around raising taxes today, yesterday, and so on. Taxes could go higher. This could be the last year you ever have at these all-time record low tax rates. And if it is, you don't want to miss any potential opportunities to reposition your assets. So do something with this, because you never know. Next year, taxes could be higher, and then you'll be kicking yourself. So again, if you're interested in talking to us for a free assessment, click on it. There's no cost, no obligation. We'll spend a couple hours with you, give you some thoughts on your investments, your future cash flow. Can you retire? When should you take Social Security? And also your taxes. How are you positioned? What steps should you take given current low tax rates and potentially higher tax rates in the future? Beyond that, again, I'm Brian Perry, Executive Vice President here at Pure Financial. Thanks for tuning in, and looking forward to talking with you in the future.